Hey guys, had a little bit of issue there with the software there. Hold on just a second. The YouTube has changed their live stuff, and I just gotta get used to it here. So just bear with me just a second. They've changed their live streaming, and I'm gonna go to this guy, and I'm gonna go here. Then I'm going to go here. Hold on just a second, my friends. And go here. And then we're going to go and we're going to get this guy here. Hold on just a second. I'm hoping people aren't on this other one. All right, good. Tom, gotcha. Steve, right on. Rob, first, right on. Jerry. Steve's unsubscribing. Appreciate it. Hey. Hey, bud. Cameron, Dana. Hey, buddy. What's going on? What's going on? All right. Let me just make sure my other one has deleted here. Hey, this thing is okay. Cool. There we go. And we'll delete that guy right there. All right. All right, cool. There you go. All right, right on. So, Rob, I appreciate, that guy was calling me an imbecile on the thing, and I appreciate your defending him. But my thing is, at the end of the day, the name calling is stupid, silly, but let's make people argue their case, man. I mean, it's just like, look, it's easy to say science says, or everyone thinks this, or you're an imbecile, but that bores me. I've heard that. It's like childish. If people got a case to make, I'm entertaining it. I'd love to hear it. It's kind of like my man Alberto. He talks about reverse mortgages. His case is well thought, well argued, and it's spot on. And that doesn't mean I agree with it, but it's argued because he did the research. And I think, and I know what you're doing is you're saying, hey, look, this guy has a right to be, a moron, just like you and I have a right to be a moron. But Daniel, I cannot stand when people can't make the case. That's my biggest thing with not just politics, just modern day, just stuff here. Hey, is it false dichotomy? You think that, thus I think this, and we're diametrically opposed. I got a guy posted on my thing. I've gone Christian right. I'm like, huh? I was doing last April on Easter. I did a thing about my own testimonial to how I came to the Lord, and of course, my fifth video was about the need for fossil fuels. So I don't like that whole thing. Like, you just changed. I don't know, it hasn't. But anyway, argue the case, man. Argue the case. Exactly, Steve. So Steve says kids coming out right out of college may know stuff I don't know. So challenge me, but in a healthy way. I agree. I completely agree. Challenge. I mean, if you got the case to make it. It's actually funny. So I've talked a couple times about this book right here, Tom Wolfe, The Kingdom of Speech. And I'm reading this. Actually, I'm listening to it on my audio when I go for a walk, because sometimes YouTube is just this. Sometimes YouTube's fine, but other times I gotta get. I've had this book sitting here for a while, and I just don't have the time to get to it. So speaking of which, I just got on Audible. It's $14.95 a month. You get 2 books, I think, for free. Well, not for free, but 2 books a month. Harry, what's going on? Phil from Indy. Troy, right on, man. Hey, what's up, Harley? My man Harley from Heflin Auto Repair in Kansas City. See him. All right, Troy. Throw questions out there, brother. So yeah, I can do the best I can to answer, but you got to put your question out there, man. So anyway, what was I just saying? Oh, so I got, yeah, exactly. Rob, more shootings in Chicago. That's what actually infuriates me. They have the mass shootings, but until the like Bangor, it's funny because they're shooting. I was just reading the other day that Baltimore is actually more violent than Honduras and Guatemala. These are Americans, man. These are American cities. And it's not just all gang-banging thugs that are taking the bullets. I mean, even that was the case. It's still wrong. I would argue prohibition leads to that kind of behavior, but we can argue that differently. But when Americans are dying en masse, it's just they're doing it day by day by day. And we know there's another reason no one cares. I mean, let's not pretend here. We know why no one cares what happened in Southside Chicago or Baltimore, why no one writes about that. We know this, but yet somehow when there's a mass shooting, which is horrible, that's not any more horrific than happens every weekend in Baltimore, Chicago. It's just not. It's nuts. It's just sad. Oh, yeah, it's pretty easy to avoid Chicago, but not unless you live there. That's the whole point. If you live there, Mike, and you're a kid, you're a single mom trying to raise your kids. Yeah, I don't know. I think that's might be pretty easy for you, but it's not pretty easy for those others. And just because it's easy for you to avoid it doesn't mean it shouldn't be front and center. If you know what I'm saying. I'm not trying to chastise you, but there are people in there who can't get out. And why should they be bearing the brunt of criminal activity any more than you? It's not right. And again, I'd argue it's prohibition. I also argue a lack of man taking care of their children too. But at the end of the day, just because you don't have to drive through Southside Chicago doesn't mean we should just poo-poo that and focus on a Walmart shooting. It's I think it's sad. Hey, what's going on? Maryland, we all know Baltimore. Sorry, but Trump is right about this one. Yeah. All right. So where's got your Social Security book 2 days ago, Mike? What's your thoughts on that? I'd love to hear. And my man Harry's on here. We got Phil. Okay. So just while a couple things. Yeah, I had Green and Passers. How to retire on $3,000 a month, Dan. Flying Illinois Class G. All right. I'm subscribing tonight. Oh, yeah. The point about that video is that I got you. I just the bombastic, the negativity, it gets old. I just can't take it. I mean, I was reading, I get this newsletter called Nick Murray, nickmurraynewsletters.com. And if you're a budding financial advisor, Nick Murray, you need to read him and everything he's written ever. The guy's just freaking a monster. And he has this thing called Resource. I pay about $350 a month for it. He's got this thing called Resources. And it's just Nick Murray's an optimist as I am. And he talks about it like 1960. The S&P 500 has gone up 50 times. The dividends have gone up 25 times, and inflation's gone up about 2 times, whatever, 5 times, something like that. And the issue that we always refrain back to or go back to is that we're in a bear or we're waiting for the next bear market. And the facts are we haven't had this run like this for the last 15 years. We haven't. We've had negative markets big time. They might not qualify for the arbitrary bear, but in the last quarter of this last year, the market was down 19.8%. The first month of was it in May? It was down 7%. So from May to the end of May, the markets were down 7%. I mean, that's a pretty violent erosion. We had an 8 and 15. Was it 15? It was the market got hammered, and then again in 11, the market got hammered. So even though we haven't had a calamity like 2007 to 2009, we certainly had a pretty doggone close bear market. This whole idea that we have more volatility now than ever before, it's nuts. It's crazy. And then if you look at small caps and international, the same thing. They got hammered in 2015 as well, and other times too. So I don't get this whole thing like a bear is imminent simply because we haven't had one. Well, we've had volatility, we've had declining in the market, and on top of that, don't forget we were coming off the worst market for like that time frame that we've ever had. People say the Great Depression. After inflation, the market from October 2007 to March 9th of 2009 was worse. Now I'm talking about the 30s on. I'm not sure 1929. I have it there, but I'm talking about the 30s on. In fact, we could probably look here real quick. The market was worse in that time frame than ever after inflation. So it's crazy. All right, so here's my man Mike. Let's see. I saw your thing, Mike. Let's see. Mike says he's trying to retire $3,000 a month. PIA is roughly 2,000. My AIME is 4,553. All right. 27 years of contributions. I worked out of the USA. Worth working 3 more years will move the needle for me. It's really hard. All right, so that's a great question, Mike. I appreciate that. Let me get my trusty calculator. Hold on. All right, so I want to give an example of how this. Oh man, it still hurts a little bit. I went to the physical with my doctor again for follow-up. He said, "Move your arm like that." I did like that, and he gave me this look that scared the hell out of me. He goes, "Man, I've never seen anyone be able to recuperate as quickly as you did." I said, "Okay," because he gave me this look like, "Is he gonna freaking punch me?" All right, so Mike's PIA is right there, 45.53. All right, so I want to talk about this a little bit. This is AIME. All right, so we got an AIME of 4553. All right, so we know what we do here? So what we do, and just so as a Mike, you obviously know, well, maybe you don't. So let's just go over this. We take the first roughly now I can't remember off the top of my head. We're gonna say $900, and we times that by 0.90. And it's not quite $900. It's right around that. So we take the first $900 and we times that 900 by 0.90. I'm not exact. I can't remember the exact amount. I could look at it, but I don't want to. So this can be off by a couple bucks in terms of your bend point. So we get 900 times 0.9. So we know the first $900 that you get, you're going to get $810 for benefit. So the first bend point is $900. So we have AIME, an average index monthly earnings of 4553. All right, the first 900 of 4553 equals $810 of income because we times that by 0.9. All right, so we're gonna put that 810 kind of on the side here real quick. All right, and so now we got 4553 minus 900. So 4553 minus 900 equals 3653. 3653, and then we times that by 0.32. Times by 0.32 because that's a second bend point, and that gives us 1168. So 1168. So what you'll see here. So we got the first bend point is 900. The second bend point is the difference between the AIME minus the 900. Whatever's left over is a second bend point until you get pretty high up there, and then you have a third bend point, but we're not anywhere near that. Times that by 0.32, that gives us 1168. So we take 1168, add it to that 810 plus 810, and look at that, spot on. So there you go, Mike. So Mike's PIA is right at what he's saying, 1995, roughly. I got 1978, but doesn't matter. So close. All right. So then the question is, Mike saying, if I work a couple extra years, will that add to my my benefits? So now what we do is we take that 4553, and we're going to times that by 12. All right. We're going to take his AIME, his average index monthly earnings, is 4553. So what that means is the last 27 years, the Social Security Administration has been inflating that with the indexing factors they use on the average wage index, so the AWI that they use. And so what that means is in today's numbers, he has averaged $4,553 a month in income. So we take 4553, we times by 12. That means Mike's income right now is, according to that AIME, is 54636. So that's essentially what the Social Security looks at and says that is what your income has been averaging in today's numbers over the course of your 27 years history. So hang tight. So if Mike works on that kind of income, if Mike works another 4 years, we times that by 4, and we're not going to index it because he's pretty doggone, well, it'll be indexed a little bit, but it won't matter much, times by 4. So essentially, he'll add another. So we take that 4, because he says he's going to work for another 4 years. So we're going to take that average yearly earnings at 54, whatever that says, 636. We're going to times it by 4. That's going to give him $218,544 more of income that we. So bear with me just a second. So we're going to have $218,244 of income so far. Is that you with me so far? So we're going to add that to his average index monthly earnings. So bear with me just a second. I know it's confusing, but I'll wrap this in a nice little bow. So on his average index monthly earnings, which is 4553, what we're going to do, and I don't know exactly what his salary is, but I'm just using how Social Security looks at that. So what we're going to do is we're going to say, okay, we're going to have 4553 times, we got, let's 480. 4553 times is wait, hold on a second. We got 35 times 420. 4553 times 420 plus 218,544 So he will get divided by 420. So now his AIME will go from 4,553 to $5,073. $5,073. So now what we're going to do, so by him working 4 more years, it'll increase his average index monthly earnings by about $500 total, which isn't bad. I mean, $500 isn't bad, but we know immediately how much that will net him, because that's in the second bend point. So he's going to get 32 cents on the dollar at that 5,073. So that will net you, Mike, an extra 100 and five. What did I say? 505. I can't remember what I said. 5 minus 900. Hold on just a second. 505 minus 4553 times 0.32. That's going to give you another $160 a month, Mike. $160 a month, roughly. So if you were to stay working for another 4 years at that roughly $55,000 a year, now my numbers aren't going to be quite as spot on, obviously, as Social Security, because I'm doing it on the fly. And you've only worked 37 years. You haven't worked 27. You haven't worked the full 35. So you're probably actually making more than 54,000. You're probably making 65, I imagine. And you don't have to answer that, but I imagine you're probably making 65. But either way, if you worked another 4 years and you made $55,000 a year for another 4 years, that'd only increase your benefit by about $160 a month. All right, so $160 a month times 12, that's less than $2,000 a year. I don't know. So I mean, if you're in a job you can't stand, that's, in my opinion, it's not worth it. You can easily redeploy that 2,080-hour work year. So you got 40 hours a week. If you're doing 40 hours a week times 50 hours a week, 50 weeks a year roughly, that's 2,080. That's a 40-hour work week is 2,080 hours in a year of what you're working. So can you deploy that 2,080 hours a year into something else that would generate more than $2,000 a year in extra income from Social Security? That's what you have to think about. And don't forget, if you're going to work an extra 2,080 hours a year for 4 more years, and you're only going to net less than $2,000 a year on Social Security benefits, that's a lot of. You're not making much money. I mean, you're just not making much money at all from the time you're going to commit to staying at that crappy old job. If it's a crappy old job, if it's one you're okay with, like I have a good friend, and I want to talk about USA and Schwab, by the way. But anyway, I have a good friend who got a job offer to stay with Schwab, and she's going to get paid big bucks, and she likes her job. I said, you should stay. If they're going to pay you a big bonus to stay at Schwab or USA then Schwab, why leave? But if you don't like your job, Social Security isn't going to it's not going to be much better for you. That's for sure. I hope that helps, man. J Dubs from PA. Just going back to Chicago, the lady who did my blood work told me she took her 2 boys out of Chicago. She literally just up and left and found her way to Atlanta, got a hotel room, and she's a single mom raising 2 kids, and just went find anything just to escape because she was so scared for her kids. Are there new regulations in 2019 that would prevent a old Roth 401k rollover to a Roth? Not that I'm aware of, Cameron. I don't know. New regulations that prevent an old 401k rollover to a Roth. Not that I'm aware of, but if anyone wants to pipe in on Cameron's question, that'd be great. So Troy says, we take care of my mother-in-law. We have a rental agreement and a caregiver agreement. So afraid of my wife's sisters going after us after she dies. We take care of my mother-in-law. We have a rental agreement and a caregiver agreement. So afraid of my wife's sisters going after us after she dies. Would a trust help to protect my assets? They can't get your home. They can't get your retirement assets. So if you had a bunch of money in I don't know. I'd have to, I guess if you had like an individual account that, $200,000 in just a good old fashioned brokerage account, I suppose they could. But yeah, you'd have to see legal on that. That's for sure, Troy. Absolutely. What would I consider a safe interest rate for retirement planning calculations? I just look at the 10-year treasury. So I like the 10-year treasury. And right now it dropped below 2% since the last time we chatted. And right now the 10-year treasury is, well, jeez, oh, look at that. 10-year treasury. TNX is a 10-year treasury. 1.855. 1.855. And then just, if you want to see something funny, let's see. Hold on just a second. Look at that. CNBC. Traders are betting on a sudden drop in stocks. Let's see. Spotting bubble trouble with Robert Shiller. And so Shiller is the guy who runs, I love Shiller. He's did the CAPE, the cyclically adjusted price to earnings ratio. Let's see. And yet there is one. Corporate profits have soared. So I just find it funny. That's pretty good. So look, if you look at this on your Apple phone and you always see negative Nellies on here. Perfect summer storm brewing for a stock correction as trade war simmers and more Fed, blah, blah, blah. You can't, this stuff will drive you insane. So put it away. It's like getting off Facebook. Your life is so much better. Another problem with Chicago. Yeah. Right on, right, Rob, is the middle class leaves. Exactly. Live lean and frugal and have your house paid off. Couldn't agree more. Hi, Josh. I don't know if there's a lot going on negatively or if we're just more aware to the media outlets such as social media. Yeah, I think it's probably something to do with it, Tina. I mean, just look at, we are safer today. Don't tell anybody, but this is what my wife and I argue about all the time. Our kids are safer today than they've ever been. They're not going to get abducted. They're not going to be taken. They're not. But yet we're hearing more and more about kids who get abducted and taken because it's social media. I mean, that's just a fact. But they're not at more risk today. Shh, don't tell anybody. Kids are not getting abducted. The idea that you can be sent to CPS or whatever for allowing your kids to walk to the park, which, have you heard about this? Jeez Louise. We're safer today. When I was growing up, when I hit 5th grade, I didn't live in town, so I had to take up that stuff. My hand is still in my eye. I think it got to be a habanero pepper I had, and I put it on my eyes a little bit. So if I see me going like this, because my eyes are a little bit spicy, not my language, just my blinking might be kind of spicy. So you see me with my eyes a little bit. It's hand still hurts. That's going on 6 hours, man, and my hand is still hot from that stupid habanero. So if you haven't seen my video, what I did is I took one of these, what Walmart called was a mild jalapeno, and I scrunched it, and I got the juices out, and I rubbed it on my tomato plants to see if I couldn't keep the squirrels at bay and the deer. And then I said, while I'm doing that, let me rub it on part of my skin that I had this like kind of an itch, and see if that burns it off. And man, it burned. It still burns. That was 6 hours ago at least. Nuts. Let's see. Oops. Let's see. Hold on just a second. Yeah. Tom says, unless you have trying to protect your assets. Look, hey, Jimmy, what's going on? Think about the trust. The trust can work out, just because you. All right, here's the way I knew it from the lawyers I've worked with before, who are business lawyers and use the LLC. They call it a veil of. We're going to pierce the veil of. Rob would know it. The veil of. So if you have a limited liability company, an LLC. They say we're going to pierce the veil of. There's a word I'm looking for. I can't remember, and that would be where just because there's said LLCs and living trusts protect you, do we really know that to be true? I don't know. I'm certainly not an attorney, but that would be something you definitely want to talk to. You definitely want to talk to a legal guy about that, or lady. Dana, my man from Portland, says, "How do you teach your own children about finance?" And that's a tough one. Dana, I'm of the philosophy that I really truly believe that's nature more than nurture, if that makes sense. And there's, like I said, a couple videos, there's a guy named Brian Kaplan who had written a book. He's an economics professor. He used to be from George Mason. He might still be there. And he just says, selfish regions to have more kids and just let them do what the hell they're going to do. And, because they're all different. And so I think, having some, we have discussions, talk about the 401k. My youngest one, we talk about the 401k. My oldest one is a natural saver. My two middle ones are not so much. And, we talk, but they're just not that interested, frankly. And chores don't do it for them. I just think it's nature. Like I've always been hard. I've always liked the idea, if I do something, I can make more money. I'm going to do more for it. I'm going to do more of it. It's just always been in me. I don't know. Maybe it's a little bit nurture, but I think it's mostly nature. I've never been one to say, I've always liked the idea, if I work hard, I can get paid more. I've always been fond of that. Whereas two of my kids, they're just like, yeah, they'll work just enough to get what they need and move on. And it's, I don't think there's anything I can do to change them on that. I think they're just gonna have to, come to grips with, at saving and all that stuff. And I'm not sure what I can do to change. Now, we talk about savings. They want a pool. I said, we don't have money for a pool, fool. So we got no money for that. And they're like, what? Freaking Jenny from the block has a pool. I said, I don't care about Jenny from the block. We're not Jenny from the block. We're Josh from the island. And no Josh from the island can afford a pool. I'll tell you that right now. And so, they just don't see the picture the way I would see it for sure. So, that's how we don't really do allowance. I don't keep a whole lot of cash. I keep a stash of cash. For emergencies, because I'm a prepper, but I don't keep a lot of cash in my wallet to give to them, chores. And Frank, I don't want to be on them, like, do that. If the stuff needs to be done, I just do it. It's the way it's always been. And my wife kind of gets on me. It's Liam's turn to do the dishes. And, generally if I have some thoughts on, hey, get to the dishes, but generally speaking, if it's there, it needs to be done, I just do it. I don't know. I'm not good at kind of maintaining some kind of, do this, do that, your turn. But, when it comes to mowing, I'm on them. I'd say, hey, get out there and do it. But I don't know. That's just me. Steve says, theoretical question: if you're making $200,000, does it make any sense to start Roth conversions in the early 50s? One video I saw talk about having large pensions should not. Yeah, hard to make the argument about, in my opinion, about the Roth conversions, or even Roth into your 401k if you're making that kind of money. That's just tough, man. That's tough, especially if you're single. It really, in my opinion, Steve, it comes down to, at some point, if you're married, your surviving spouse will be in a higher tax bracket, without question. You can make the argument much, much better in that case, because we know there will be a higher tax bracket, unequivocally. If you're single, I don't see the benefit. I just don't. And if you're single with a pension, I absolutely don't see the benefit. If you're married, it may be, but it's not quite as easy as, someone's making $55,000 a year, $60,000 a year household income, and it's just not going to be quite the same. So hard to say that'd be beneficial to you for sure, Steve. But all right, so Mike says he's making a salary of $95,000. All right, so let's take a look at this then. So we can still go back. So Mike's making $95,000. He wants to work. He's thinking about working 4 more years. So 95 times 4, get my trusty calculator. That's going to give us an extra $380,000 to add to his AIME, which was already 4,553, I think is what it said. So bear with me just a second. Times 420 plus 380. Bear with me just a second, my friends, equals, divide that by 420. So now his AIME will go to $5,457. So 5,457. So we know the first 900 is at the first bend point. So that means he'll have 4,557. So what's happening here? All right, so he told me he makes $95K a year. So that's going to make his AIME, if he works another 4 years, go to 5,4. I can't read my own writing. 5,7. We subtract the first 900 because that's the first bend point. So that the remaining amount is roughly 4,557. You times that by 0.32. Oops. 4,557 times 0.32. 557 times 0.32. That's 1458 plus the 1458, 1458 plus 900 times 0.9 plus 810. So he will make, so Mike, your PIA then would go up to 2268. 2268. Again, it's not quite on because it will be indexed with the average wage index, which I don't know what it'll be. But so let's say it's going to be another 20. We'll just round up and say $2,300 will be your PIA. I mean, look, I'm not saying don't do it, but if your PIA, I mean, it's $2,300 and you're already at roughly 2,000, that's $300 a month more you're going to get from Social Security. It's just, it seems to me just not. I mean, again, it depends on if you like your job or not. Thanks, Kevin. My book explains what about Mike working longer. Kevin, is that what you're saying about if he should or not? Yeah, thanks, man. That's a good plug. So don't forget my book, Live and in Person, Retire on Social Security. It's even got a big enough space for a spine, which I did put on there. And look, they're sitting at the beach because you have to have a beach in retirement planning, right? Because they're sitting on the beach, max and relaxing. I've never seen a statistic on the average Roth account balance. No, I haven't, Mike. That would be interesting to see. However, I think the Census Bureau has that, and I think it'd be pretty easy to find. I'm not going to do it now, but I think the Census Bureau or is it IRS data? One of those two has that data, and it would be easy. I bet it'd be pretty easy to put two and two together there. The drawback with the average balance, it doesn't say much. I'd like to know the median balance instead. Interesting. My man Kenny says, I'm 54 and contribute to the max of the 401k pre-tax. I'm retiring in 5 years. Should I do the Roth in my 401k instead? So basically my default is yes, but you'd want to convince yourself not to do that. So it's kind of like you just say, see, the way I look at it, Kenny, if you're married, you should probably do it. It depends on your income. Like my man up here, I forgot his name. He's making $200,000 a year. Yeah, maybe not. But if you're married and making $70,000 a year, absolutely, in my opinion, absolutely. If you're married making $125,000, yeah. If you're married making $200,000 and you got a pension, yeah, probably not. It really, the reason the marriage thing is because what we're trying to accomplish here, my friends, is are your taxes going to be higher or lower in the future, or your tax bracket? And if you're married, we know for a fact, unless you die simultaneously, your tax bracket will be higher. We know that because you'll no longer be married filing jointly. You're going to be a single taxpayer. So because we know this, to take advantage of the tax code today, if you're married filing jointly, it's worthwhile doing for sure. But if you're single, and it's hard to say, especially when you have a pension. Now, if you're single and all you have is, a Social Security and no pension, just 401k money, then probably because of required minimum distributions, they're going to face you in the future. But if you're married, I would say default every single time that you should do the Roth until you can prove otherwise. And generally speaking, that'd be a current income stream. By the way, my new shirt, Austrian Revolution. So some guy who said, I'm a Christian, right? Well, I'm a Christian. I don't hold myself out as right wing. I hold myself as a complete above the right and the left for sure. But with that said, Austrian Revolution, the Mises University, Ludwig von Mises, Ludwig. Great info, you got it right on. Are we in a trade war now? Yeah, we've been. We've been in a trade war for a long time, Harry. So I want to show you something here. This is an article. Well, I guess it'll show my right-wing bona fides. Powerline.com, powerlineblog.org.com, powerlineblog.com. These law professors must not have much to do because I have a bunch of law professors on my websites, and it's very, very interesting. So, Instapundit over at University of Tennessee, Legal Insurrection over at Cornell, Powerline are 3 law professors, and then tax. Oh, let me show you tax. This guy right here, tax prof blog. He's pretty good. All right, so I want to show you this article I was reading about. I'll probably do a video on it tomorrow. This guy, Michael Oslin, published the book "The End of the Asian Century," And now he's got a new essay in foreign policy that he finds prospects for Asia in general and China in particular have diminished further. China's decline seems undeniable, as does Trump's contribution to it. China faces non-economic challenges as well as economic challenges as well. Their ongoing attempts to squeeze Hong Kong and Taiwan's democracies reveal just how tenuous political stability is in the region. In Hong Kong, 7 weeks of anti-China pro-democracy protests are coming dangerously close to forcing Beijing to decide whether or not to intervene. If it deploys troops to restore order, it could lead to another Tiananmen Square, the bloodiest crash in 30 years. Anyway, it's pretty interesting now. So I don't know. I mean, I think the trade war has been going on. It's just China has been mopping us up because we've been too nice, frankly. This is my whole thing. I was reading this was a right-wing blog, Red State. And the guy was like, Trump's trade war. I was like, what the hell is this? Why? I mean, this is a right-winger guy saying Trump's trade war. It's like, Trump's just retaliating. Finally, someone's retaliating. And the same thing with NAFTA. Trump went down there and mopped up NAFTA. Now, NAFTA is much more beneficial to us. Oh, if we only listen to one, Ross Perot. He told us about that. So Trump's essentially Ross Perot incarnate, and he's doing what Republicans and Democrats should have been doing since day one, which is protecting U.S. interests. It's nuts. China's been stealing from us. We know that Nike most likely is having slave labor in North Korea to build their stupid tennis shoes. They give to China. China funnels them through Mexico under NAFTA. And so essentially we're buying our stupid Nike tennis shoes on slave labor of North Korea because of NAFTA, because they say, oh, we're getting it through Mexico, built by China with the North Korean slave laborers. It's just, so I hope we're in a trade war because that's, the last thing we need to do is go intervene militarily anymore. There's enough of that crap. We've hopefully, and I was big on Afghanistan. I was big on Iraq too. It's just the problem with democracies is once you have a change of leadership, because Bush had them beaten down in Iraq. We know that they were on the run. Then Obama, he was elected and he was running on getting out of Iraq, so you can't blame him. But the minute he took over, what the successes that we had built were completely vanished. It's no different than Vietnam and stuff. And the whole thing is just democracies lead us to make bad decisions that if we don't get it policed up in the time of that one administration, the new guy's going to come in and really change things. And that's bad. So we can't be doing that anymore. Enough. We got to protect it at home. But anyway, I think we're totally in a trade war, and I hope so, because we need to protect our interests. And about damn time, pardon my French. So anyway, I'm looking forward to reading this article. I haven't read the whole article by this guy, Michael Oslin. I do get a little bit. There's a guy named Michael Ledeen, who is, I remember 10 years or so ago, he's talking about the imminent decline of Iran. And he was basically saying Iran will fall in a couple of years. And I think Obama did badly on that when the green revolution took place. And we saw that lady get literally killed in the street. And Obama he didn't do it. What can he do, though? I don't know. I mean, we're not going there with guns. That's nuts. But we certainly don't give him pallets of millions of dollars. That's for sure. But Michael Ledeen, I think, or Ledeen, I can't remember, but it's Michael Ledeen, and he writes in Commentary Magazine. He was talking about Iran's imminent fall. And so anytime I see these articles about the end of something like that, I'm always I wonder if that were to be true. Because don't forget, Paul Samuelson, the economics of all economists, all right, the economist of all economists, who really took economics away from its tried and true, which is looking at the rationale, the decision-making, rational or irrational of human behavior, and made it a mathematics equation, essentially a barrier of entry to people who don't want to engage in econometrics. And physics envy. I mean, that's what this guy had. So Paul Samuelson in 1989, in his published textbook about macroeconomics, was stating that the Soviet Union was going to overtake the U.S. Well, we know what happened. So anytime I see these articles, I always kind of wonder, but it's interesting to me nonetheless. So we shall see. I don't know. We will see how this shakes out. I find it interesting that we've all been under the like Thomas Friedman, been talking about China for a long, long time about how they have it right. It's funny too, because some of us on the right will say, actually libertarians will say Pinochet. That's how it should be done. You can't have democracy and free people at the same time, because democracy always means 50 plus 1. If I can gather 50 plus 1, I can essentially enslave those 49. That's how democracies really are. What you truly need is a benevolent dictator, like, I hate to say benevolent like Pinochet, but that's generally speaking what a real libertarian would say is that's what we need, a guy who's going to be hands off and let you run your life as you see fit, and only step in to make sure property rights and government law, I think, contracts are adhered to, without obviously the guns and violence. But you'll never, it's humanity. You're never going to get that happen. I guess Hong Kong was about the closest thing we could get to that, and that's why Hong Kong was so freaking awesome. It still is. I've never been there, never will go, but they knew they had the benevolent dictators essentially in the UK, and China couldn't go in there, or else it'd be hell's bells to be paid. Sad to see this happen when they gave it over. Well, I think it's 1997. And by the way, if you see me itching, it's because jalapenos or habaneros. I think it is habaneros. Anyway, it's interesting. So thanks for your question, man. Is it possible to convert an old stagnant 401k to a Roth? Yeah, absolutely, man. Absolutely. My man Rob, another great show. Totally worth it to me to spend my valuable time listening to your wise advice. Well, you're the attorney here, big man. So if you want to pipe in on any law-related questions or anything, by all means, do so for sure. Pierce the corporate. Yeah, there you go. Pierce the corporate veil. That's exactly right. See, look at that. Pierce the corporate veil. That's what this guy was telling me about LLCs. He saw all these people think they have an LLC. And he said, because this, right on, Pierce. Yeah, he said they have an LLC. They think they're shielded. He goes, no, there's going to be some guys or ladies going to come in there at some point and pierce the corporate veil. Exactly. And I think, thanks, Steve. Hey, Josh, that's a great idea. Josh, index card financial planning. I like that's a good idea, brother. Thanks for the bucks, and thanks for the idea. All right. Yeah, right. If you convert your 401k to Roth, it would be taxed. Right on, Tom. Inverted yield curve. Oh my God, we're all gonna die. I mean, woo. All right, that's AK. Yes, man. So my man AK says inverted yield curve. We're all gonna die. Aluminum futures. It is funny, the inverted yield curve. Remember, because they were telling us back at the end of the year when the markets were collapsing, that the inverted yield curve meant a imminent recession. And if you remember, your old buddy Josh put a video out there, and I think Graham Stephan did the same thing, which I was that's why I like that guy, Graham. I'm enthralled by his channel. A lot of that stuff is a little bit, I don't care. Like, he did a video where he's in some rich guy's house. That I could care less. But I like what he talked about, the inverted yield curve. But I beat him to the punch, your old buddy Josh. I said, look, if you look at the inverted yield curve, when it happens and when the recessions come, there is no correlation there. There's none whatsoever. It's just a correlation of you dying if you eat carrots. Did you know that? If you eat carrots, you will die. There is 100% correlation, literally 100% correlation. If you eat carrots, you will die. There's 100% correlation. If we have an inverted yield curve, there will be a recession. There's also 100% correlation. If we don't have an inverted yield curve, there will be a recession. Can't take that deep thinking, can you? Huh? The point is, there's no correlation which equals causation, or causation correlate, whatever the hell that is. You know what I'm talking about. And so I just always chuckle. Inverted yield curve. All right. Jim C. All right, man. How much does a pension affect my Social Security? Big time. Big time. So this is the drawback about the pension. Look, man, I love folks having a pension. I absolutely do. But the drawback is you have limited tax choices in terms of tax planning. I deal with this all the time with financial planning clients that hire me. There's not much we can do from a tax perspective other than taking care of the widow's tax trap. So we got Josh and Charlotte's got a pension of $30,000, and we're trying to do some tax planning to reduce our taxes while we're both alive. It's tough because that pension immediately obliterates our standard deduction. So essentially, any income we get above and beyond the pension immediately be taxed at least 10%. And that will include Social Security, because if you look at the provisional income tax rules, which I did in my book, Tax Bomb in Your Retirement Account, and I mean, I talk about this in detail. Once you have a certain amount of income, provisional income, your Social Security will be taxed at roughly 85%, not roughly, really 85 cents on the dollar. So now you got your pension, you're adding, it's almost like a cake layer. You got your pension, you got your Social Security, and then you're going to have RMDs, required minimum distributions. So there's really not much you can do from a tax perspective in order to avoid a really significant tax planning. Now, what you should do though, Jim, is that you should, in my opinion, if you probably get your pension at 60 or 62 or 65, one of those 5 years. If I may, just real quick side note, I can't believe how many people I've had who said, well, I get a pension that pays out $2,000 a month at 65, or I get the pension that pays out $2,000 a month at 60. What should I do? And I'm like, does it have any adjustments? No, it's $2,000 a month then, or $2,000 a month now. And I'm like, so literally it costs you nothing to take the money out, or you get no benefit for delaying. No. You should take it out like now, because if you don't, that's literally just leaving money on the table. I've had that happen a number of times. It's crazy. And people get it once I explain it to them, but it's like, again, it's so obvious that it needs a second party or a third party, whatever, to explain it to them, because it's so inherently obvious they miss it. And that's the thing with some of this stuff, is so obvious that people think it's got to be more to it than that. Sometimes there isn't. All right, so going back to your question. All right, so you're 60. We're going to say we're have you retire at 62. You're getting your pension. I certainly say, and I don't know if it's a government pension. So if you're dealing with WEP, windfall elimination provision, or a GPO, government pension offset, we won't talk about that here right now. But let's just say it's just a good old fashioned. You're working for the police union, and you've been paying a Social Security, so you get your pension and Social Security. Man, I'd take that freaking pension right now, and I'd start converting your 403B money without touching Social Security until I'm 70. So I'm 62. Got my pension. I'm 55, got my pension, whatever. Start pulling that money out of your 403B, start converting that to a Roth, or just living on it for sure. Take Social Security later, and hopefully by the time you're 70, you got no money left in the 403B. It'll all be in a Roth IRA. And then you can take Social Security. At that point, you're just going to have your pension plus your Social Security. Probably not going to have much of a tax consequence there. I hope that makes sense. A lot going on there. My man, Frank. Right on, man. Right on. I saw your post today, Frank. Appreciate it on hanging in with the Heritage Wealth Planning YouTube channel, even though we don't agree all the time. Nuts, huh? Not to agree and still be polite towards one another. How crazy. Frank doesn't agree. He thinks that if you eat carrots, you'll live forever. That's what he said. Just joking. In retirement, what % of increase do you allow for healthcare? A few years ago, by federal Blue Cross Blue Shield increased over 10%. The next year, less than 2%. Hard to project, I guess. The CMS, Centers for Medicaid and Medicare Services, say 5%. That's their trustees report. That's what I use in my financial planning. Frank, is 5%. That's what I use. So actually, it's interesting. I was reading an article the other day that the private plans not going to have an increase this year in terms of their plans they offer for the first time in a long time. And I think which is odd, because everyone thought once they got rid of the individual mandate, the private plans would jump up, because they're like, how do we price this? And what they were doing is they're pricing it, I guess, too high. I don't want to say too aggressively, but under the worry that they'll be held with a wet bag once Obama got out of office and other people took over and messed around with it. So look, I don't know. I wasn't a fly on the wall, but the interesting thing was they were pricing too high, the price increases, because they saw the risk coming. And so even with the individual mandate being eliminated, and thus there's no guaranteed client base, essentially, they were able to, I think it was even reduce their prices, or at least not have a raise for this year. It's amazing what happens when you have some kind of consistency that finally settles into these things. How insurance companies, because remember, insurance companies, the whole point is to evaluate the risk to them. All right. So they're saying, if we take an old Josh as a client, and Josh doesn't smoke, but we turn out he does smoke after we take him on, we got to evaluate that risk. What is the risk for him? Well, for the insurance company, they say when they did a autopsy and they found out I was smoking, they'd still pay to make the death benefit, but they would have chalked it up to, they would increase my premiums I would have had to pay if they had underwritten me as a smoker. Does that make sense? Because they essentially say I lied. But still, they got to pay this pretty big death benefit, which they might not have even issued to me if they knew I was a smoker from the front end. Does that make sense? And so the insurance company always has to evaluate the risk of what will happen to them if these catastrophic events happen. And if so, they got to be prepared to pay out. And if everything is volatile because they don't know what the hell the odds are going to be, they're going to raise their premiums like crazy just to cover their butts. No other way around that. So now we have some semblance of a lack of volatility there, at least some kind of a flow they can bank on. It sounds like that might be a case that the insurance companies are offering less of a premium increase. And again, this year, none. So we do 5%, Frank. CDs I get are paying 2.4% monthly. Right on. I like that, Mike. That's pretty good. 2.4% monthly. So you're saying it. I don't think they're paying 2.4% every month. That'd be a 25% rate of return, right? Just contact your broker. Right on. AK. Remember the days when you could ride around with your Crossman pump shooting random shit. Should a 401k double every 7-8 years on average? So my man D Whitlock, what would that mean? If you got doubled every 8 years on average, what kind of rate of return would that be? Do you know? So are you familiar, guys, with the rule of 72? I'm sure some of y'all are, but if you're not, that's okay. You got to learn sometime. So the rule of 72, you take your trusty whiteboard like this and you take a number, divide into 72, and it says if you were to get 10% a year, that means your portfolio would double every 7.2 years. So you take the number 72 by your interest that you're going to get, and that means it doubles every 7.2 years. So Mike D. Whitlock is asking if it doubles every 8 years on average, all right? So that means we got to take 72 and we're going to do 8. So it's going to double every 8 years on average. So we're taking 72, it doubles every 8 years on average. What is that? What's the divisor? And that'd be 9. So you have to get a 9% rate of return for that to double every 8 years on average. That's on a little bit of the high end, I would say, D Whitlock. I would look, man, I think when I'm running plans, if it's all U.S. stocks, I use 7.5. If it's stocks and some bonds, it drops dramatically because bonds, well, I just showed you. I mean, the 10-year treasury at 1 point, I mean, it's freaking nuts, man. 1.855. That means I'm literally locking my money in for 10 years. I'm only getting 1.855. That ain't going to get the job done. And so if you have 50% stocks, all right, so let me show you how I do this. You got 50% stocks and 50% bonds. All right, so we're going to make this simple. So we got 50-50, 50% stocks, 50% bonds, and your stocks are getting 7.5%, and your bonds are getting, we'll just say 2. All right, this can be tough to see. What we do is we times these numbers. We times 0.5 by 2. We times 0.5 by 7.5. And I'll show you what it comes out, how you can get a gauge of what a 50-50 portfolio would look like. So 0.5 times 2, that equals 1. So our bonds will give us 1%, all right? Because we're getting 2% on bonds, but we only have 50% of the portfolio in bonds. So the bonds that we're getting are getting 1%. Stocks, on the other hand, 27.5 will give us 3.75 because we have 7.5% is what we're expecting to get on stocks, but we only have 50% of our portfolio in stocks. So then we take the 2 and we would expect a 50-50 portfolio would give us a 4.75% rate of return. So again, the half of the portfolio in stocks, we expect stocks to give us 7.5, and we just, in this case, it's simple, just 7.5 divided by 2. But you got to look at it, if it's 80% stocks, 10% stocks, in this case, 0.5 times 2% is our bonds will give us 1. We add these two numbers together. Our expected rate of return, our ERR, which is pretty big in financial planning discussion, the vernacular, is 4.75. And that's on a middle of the road portfolio of 4.75. And so, for you to get 8% or 9% a year, you're definitely going to have all stocks. You're not going to have any bonds. And if I may, I don't know who's new on here or not, but I'm going to show you real quick. We got a bond. All right, so a bond is issued for $10,000, $1,000, whatever. That's called the par value. And then at maturity, it matures at $1,000. That's how a bond works. When the bond is issued, it pays a certain interest rate, what's called a coupon. So going back to that 10-year treasury, the coupon's 2%. So we know for a fact that every year for 10 years, you're going to get 2% a year. That's it. It doesn't compound, by the way. This is another thing about bonds. They don't compound because they don't reinvest the interest. On a bond, an individual bond, the interest isn't being reinvested. It's being sent to you as cash because that's a coupon. So that's the thing. You can't split up a bond. You can't do that. You're buying the bond. You're buying the complete $100,000, $1,000, $10,000 issue amount, and you're getting that coupon. It's literally how it works. So for every year, you know for a fact you're going to get 2% a year. That means on $1,000 bond, you're going to get, what's that, $20? You'll get $20 for 10 years. So 20 times 10 is $200. So you get $200 of interest, and then you get your money back. I mean, it's literally that simple. Everyone makes this big thing about bonds, and you come back and you collect up your money. So you've loaned the bond company, the issuer, in this case, the government, $1,000, and you'll get your $1,000 back. And then over the course of 10 years, you'll also get $200 of interest. There's no more than that. I mean, you're not getting more. You're not getting less unless the company goes bankrupt. In the government's case, they're not going bankrupt. Right. So you're not getting more, not getting less. The drawback about bonds is that every single year, you're still getting this fixed income amount. That's why it's called fixed income. So every year, though, that $20 of interest you're getting is worth 3% less or whatever inflation is. So when I use financial planning, we're using 3% less. So after the end of year one, you're getting the equivalent of $19.40 in purchasing power, because you're losing 3% a year to inflation. After the year of year two, you'll get $18.81 in purchasing power. So you're getting 20, not what's called nominal dollars, but in terms of purchasing power, the 20 is now worth 1940 is now worth 1881 and so on. And then of course your $1,000 principal that you put in that you'll get back is worth, basically 30, roughly 30% less. So that's worth $700. So when it comes to real income, you've lost. You're losing money. You've lost. That $1,000 you started with will give you $700 of purchasing power when you collect up that money in 10 years. On top of that, the $200 of interest is not going to buy you $200 of real goods, because inflation is eating away every year some of that $20 a year of interest you receive. And that's the thing about fixed income, is it's literally fixed. But we're not in a fixed income society, a fixed dollar society, i.e. the gold. We're in an inflated society where inflation reigns. And inflation just means a perpetual devaluation of the dollar. That's literally what inflation means. Our dollar is being devalued each and every year by mandate. I mean, this is the Federal Reserve. I think it's a 2% target inflation now. It used to be 3%, whatever it is. But still, every single year, they are trying to reduce the value of the dollar by 2%. So be careful, bonds, man. Mike says, when I was 12, I used to take a city bus to my grandmother's house, about a 30-mile trip with a transfer. Oh, that's what I was saying. Yeah. So when I was growing up, when I was in fifth grade, I didn't finish the story. So I said to my mom, I want to take the boat into Portland because we lived on the island. And we're basically country Hicks on the island. And she said, okay. And so I went up there, took the boat, got on the boat by myself, walked around the big city of Portland, Maine. I don't know if I think I stopped and got a hamburger even, or a hot dog, did a little hot dog vendor, walked back down the wharf, got on my boat. And, say 4 hours later, man, I felt like a big boy at that point. I was fifth grade, walking in Portland all by my lonesome. No cell phones, no nothing. But I just walked around. I saved up some money for my allowance, and I went back and said, yeah, all right. I felt like a big kid, man. It's crazy. And here's Mike saying he used to take a bus to his grandma's house in L.A. It was a transfer a block from Skid Row in L.A. when he was just a kid. Yeah, exactly. It's nuts. I bought the book, Simple Path to Wealth. I got on audiobooks for them. Solid, simple, easy advice. So, all right, right on. And speaking of which, I do buy audiobooks. And if you buy audiobooks and you get my book, or if you don't have a membership, I haven't put this on audio yet, but audiobooks, actually, I'm more convinced are the way to go. It's just, you have the time to listen to it. I was worried about this book right here, or any of these books. They're technical. Simply because I do like the idea of I do take notes, and I like to and I also like to highlight stuff. But if they're kind of like storytelling, audiobooks are absolutely the way to go. And I've heard a lot of good things about my own audiobooks. But if you do go on Audible and you sign up for a free thing or whatever, do it through through me. I get paid. And it's actually not cheap. I mean, it's pretty good. I think I got like $5. I think they call it a bounty. So if you're looking to buy an audiobook and you haven't signed up yet, if you do it through my link, I get paid like $5. I think it's $5. I can't remember, but yeah, so definitely do that. Schwab Broker wants to put me in all high dividend managed mutual funds called Thomasville Partners, 80 basis points as a fee. I wouldn't do that. Why? Especially if it's a non-IRA. So if we got high dividend managed mutual funds, if it's not an IRA market, you're going to have crazy taxes due on the dividends. And there's probably going to be some capital gains too, some turnover. They're going to do some trading, and you're going to pay a fee, which you can no longer write off. I don't like that at all. Why not just buy the Vanguard high dividend ETF? Now, I'm not a fan of that at all. Okay. So Steve said the book, Simple Path to Wealth, he wrote for his daughter. Right on. Marie in the house. What happens if I retire at 62, don't collect Social Security until 67? I have 5 years of zeros for earnings. Will have worked in my company for 42 years. Yeah, no, that's, I mean, so Marie, you're not going to affect it at all because you already have the 35 years of earnings. I mean, so your Social Security benefit, you're already losing 7 years of earnings because they take your top 35. All right. So, but you have 42 years of work, but they don't take 42 years. They take the top 35. So unless you're making a whole lot more money now to offset some of the lower money you were making that was indexed, it's indexed. Don't forget, it has to be indexed. So, just because you're making 15,000 in 1982, doesn't mean the 50,000 you're making this year is going to replace it. I guarantee it won't, because that 15,000 in 1982 is indexed with the average wage index. So that probably the equivalent of, I don't know, 70,000 this year. I don't know that, but it's certainly more than what you're making if you're only making 50 or 55 or something like that. Now, if you're making 200, it doesn't even matter then. Why? Because the average, the max is, I think it's 135 for Social Security. So unless you're making big scratch, you're not helping your, and even if you were, like I showed with Mark, I think his name is Mark or something like that, Horty, it's not going to, you already have the max years of Social Security. So unless you weren't making crap and all of a sudden you're making, major buku bucks, as we say in France, buku, Quebec City, that's French for you. It's not going to do anything. In fact, I can almost assure you it won't. In fact, you gotta get my book, Marie. If you got my book, you would ask that question. You'd already know the answer because I talk all about that. I talk about Julie, where she says, hold on just a second. Hold on just a second, Marie. I could have put your name on here. Hold on just a second. Hold on just. Julie gets a huge raise. How will that affect her Social Security? So Julie gets a huge raise, and I give you the whole, the litany of all the different ways that will affect her raise, and it won't be much. And that's a huge raise. She doubles her money. Then I say on this other chapter, how Julie's Social Security benefit is calculated, and I should go through all the stuff that happens with her earnings record. So that's her 35 years of earnings. Actually, she had 42 years of earnings too. And so some of those years, we're not using because she didn't make enough. And that's the same thing with you. So I would not stay at work just because you think you can make more on Social Security, because I don't think it's going to happen. Yeah, there you go. So Tina, jump in there. Right on. I didn't read you. I could have just said refer to Tina. But that sounds exciting because you miss your old buddy Josh with his intellectual commentary. And look, this is how I hold. There's a guy named Flossie Carter on YouTube. It's funny as hell. I don't know why. He's got this cat named White Shoes. He says, "Get out." He goes, "Calm down, White Shoes." Anyway, he was doing his drinking test the other day, and he was holding his hand up like that. He said, "You always got to hold your pinky up like that when you're taking a sip of your intellectual stimulation." My Walmart tea. Walmart. Oh. Josh, what do you think about the Simple Path to Wealth book? I love the FU money idea. Just what about just one index fund? I don't know anything about. Is that what this guy Steve just were talking about? Simple Path. Yeah, man. So both you guys are both. I don't know anything about it. So Steve just mentioned that simple path to wealth. Dan, I don't know anything about it. I guess this guy wrote it for his daughter. That's all I got. I got one index fund. That's it. I got I can't remember what it's called, the Vanguard Value Index. That's what I own. I own nothing else. I got a little bit of cash, but I do have I forgot what the ticker name was even. That shows you how much I pay attention. I do own some gold and silver. Yes, sir, Mike. And I don't own it in a mining company. I own it in my stash. I have a stash, a fireproof box, not on premise. So any of y'all thinking to come by and rip an old buddy Josh off and steal my gold is not here. You won't find it, but I do keep some gold for sure, because I think, as I've said many times, gold goes back to Jesus's time, and actually well before that. It's always had some kind of value. The dollar, I don't have any dollars. The dollar bill doesn't. The freaking Russian ruble doesn't. The British pound doesn't. But the gold always has some kind of value of some sort, and silver too. Absolutely. All right, so Maurice, okay. Tom says, Marie, this is what I did, but at age 57, I won't take Social Security until 65. Yeah, but if you worked an extra 3 years they plan to work, it would not have made a big difference. Right on, man. Tom could not agree more. Great point. My man Fred says, thanks for your videos. I'm 60 on spousal claim at 70. Max convert. Yeah, that's freaking awesome, dude. So Fred says he's taking a spousal benefit right now because he's 68. That means he got the restricted application that we all can't get anymore. But hey, more power to him. He's going to claim in 2 years. He's been doing max conversions for the next 5. I couldn't believe it at all, man. And then my man Tom says, I was just feeling old and tired of my job. I figured out how to retire early, and then I did it. Yeah, survivor benefits related to a pension. I'll make this simple, my friend. I always default to joint and life survivor. It's called a JLSA, joint life survivor annuity is what they call. I think you're nuts if you don't have a now the one time, even then you'd want to do it. I was going to say the one time you might not want to do this with a government pension offset, but no, that actually makes it more important to do the joint and life survivor annuity without question. What the GPO is, if a lot of times you'll be a husband and then a wife, and the wife will work as a teacher. All right. And the teacher, she'll get a pension of $1,500 a month. And what happens is she'll lose 2/3 of the survivor's Social Security benefit. So the survivor will use silver gold here. If his Social Security benefit was $2,000 a month, and the wife is affected by GPO because she was a teacher in some places in Georgia, some in a lot in Texas, some in California, she'll lose 2/3 of that $2,000. She won't get anything because her pension is more than losing 2/3 of what the pension was for the husband. I'm sure that doesn't make sense, but just remember, if she's getting $1,500 a month pension and she was going to be left with a survivor benefit of $2,000 a month, and she's affected by GPO, she's not getting anything. That whole thing will be wiped out. And so in that case, the husband absolutely needs to have a joint in life survivor annuity, JLSA. And so I think if you look at the difference between a life only pension just on you and a life with a joint and life survivor pension on you and the better half, there's not going to be that much of a difference. I mean, it might be a couple $100 less if it's on both y'all, but not nearly enough to take the risk. So always default to the joint and life survivor annuity pension. That's for you and your surviving spouse. Always default to that, unless you can find a reason not to. It's not going to be few and far between reasons not to do it, though, for sure. I've done videos on that, but I'll do some more for sure. Mike, another good argument for paying 24% tax bracket. It's basically saying the taxes go up. I completely agree. My man Rob and I have had this discussion back and forth, an argument, if you will. And look, the argument, we still left as friends because he just gave me $4.99. So even though we argued, when I say argue, I mean joking, but that's the issue. I mean, at the end of the day, the taxes are going to go up when the Trump tax bill expires. That's a fact in 2026. We'll see. That's what we thought under Obama, and they did as well. But there are some parts of the George Bush sunset in 2011. Some parts of that they were able to negotiate. If the Democrats had, oh my goodness, talking politics. How can you not talk politics when it comes to taxes? If the Democrats had retained their extraordinarily high, large majorities as they had in 2009, after the 2010 election, I can guarantee you the tax rates would be significantly higher with a significantly lower estate tax exemption than what we have now. But the facts were Obama and Boehner at that point. And this is just, they had a bipartisan agreement. Obama wanted to reduce the estate tax exemption and raise taxes. Boehner didn't want to do that. And they got together and they met halfway. It was great. And we had a good tax law. I mean, it wasn't great, but it's pretty good where both sides could be happy. Farmers weren't getting killed by estate tax. Middle-class people weren't having their taxes raised, and just the qualified charitable distributions, QCDs, they pushed that forward. And now Obama and Paul Ryan got together, and Obama signed legislation to make QCDs permanent. So, I mean, this stuff can happen, but the facts are, generally speaking, if a left-wing Democrat wins the White House and they get a significant, they'll never probably have again the huge majorities they had in 2009, but they don't need a huge majority. All they need is a small majority. If they get it, you probably see taxes going up. Absolutely, without question. Yeah, man. Well, I agree. So Steve says, I decided to do Roth 401k because I expect tax rates to go up. I look, man, I would never argue that. I never would argue that. I would absolutely expect them to go up too. And if you're married, we know they're going up for sure. And then my man Rob says, totally worth to spend my valuable time listening to your wise advice. And Rob's time is pretty valuable. That's the funny thing is he says totally worth spending his time listening to my prognostications, sitting in my little house here with my Austrian Revolution. But in Rob's valuable, all your time's valuable, my friends. I mean, the fact that you guys are here, listen to me, just yap and breathe hot air down your throats is freaking insane. But, Rob's a good guy and you guys, oh boy. Yeah, I knew we had to have some people coming on here, some trolls. I knew it. We just did. So, let's see here, but I appreciate y'all being here for sure because, I mean, look, man, it makes me feel good about myself. Not gonna lie to you. I mean, look, I should not look and see the comments, and I should not get, but I'm not here to piss anybody off. But I am gonna say what's on my mind. But I'm not gonna freaking, I'm not trying to piss people off. But I get it. People are thin-skinned. Hell, I'm thin-skinned. I get that. And people got to do what they got to. Just don't care. But it is satisfying, which is kind of scary in a way, kind of creepy. And I wish I wasn't like this. But when you have, I got my most people on this right now I've ever had, 216 people. Every time we do this, it seems to get bigger. And that makes you feel good about yourself. If my head ever gets so big, I think I got enough of you guys I consider friends, like my man Rob there, say, hey, why don't you spice down pipe or pipe down Piper? Your head's too big. That scares me to death. There is something called a fear of success. And if you read back my man Aaron Helmsley, which I've shared with you before, the best psychological sales skills you'll ever read, he talks about that, how you sabotage your success because you're afraid of success. Because maybe like some of the examples he'll use is that you see your dad was a coal miner and you're doing well, stockbroker, whatever. That's one of the examples he used. And you're like, I can't justify doing this much better than my dad. So you sabotage yourself, and that's a fear of success. We all hear about the fear of failure, but actually what my man Aaron would say is also a fear of success, which is just as bad and just as deadly as a fear of failure. Where a fear of failure is you don't want to do anything because you're a perfectionist. You're like, if I do it and I don't succeed, I won't feel good about myself. And that's not good because that means you're stagnant. The fear of success is you're going to do it up. You're going to do kick-ass take names up to a certain point, and then you're like, I can't. I don't deserve this, and that's not good. Yeah, right on, Edwin. Thanks for what you do, making people think about this retirement stuff deeper than just going. That I'm just going to retire. Right on, brother. My man Theo from Dallas Fort Worth got your new book last month and enjoyed reading it. Had a point on page 39 regarding Social Security assumptions and the calculations. It's nice to have the book to highlight things. I completely agree. I cannot agree more. I like have the book to highlight stuff, especially if it's technical. I need that for sure. Just me. Okay. Jordan L. Thanks for all your good advice. I'm 52, but always think about me and my wife's future self. Yeah, dude. Income stream tax. Right on, Jordan. I mean, I always think about my wife and our future income stream too. I don't have the same, I don't have the same outlook I might have, 5 years ago, even, because I think as you get older, you get more relaxed. Frankly, I think there's something to be said about that. I don't shy away from the fact I take Lexapro. So Lexapro helps me relax a little bit. But I also think at the end of the day, you start realizing, do I really need $100,000 to live if it's just me and my wife? I don't see. And that's why I did a video this morning early this morning on the EBRI study, where they're using the average. It's just the expenses are what drives retirement planning. And if we are just throwing darts up against the wall and assuming that's the expenses, that puts everything else. It's just a junk in, junk out. And I mean, you got to think about it, like truly think about it. If you're 55 years old and you're making bank because, you got kids, you got school to pay for, you're in your highest career point ever in life. I mean, fast forward 10 years, you're a whole different person. I mean, you see what I'm saying? You're like, everything changes. You're no longer that corporate titan flying all over the world, heaven forbid, and with kids and school and all that. You're just not that guy, rightly or wrongly. Some people can't take it. They can't take not being that guy anymore. Hell, I can. I mean, dude, give me a garden, some place to go swimming in, smell the seagulls in Maine. Not the seagulls. That doesn't smell good. You can smell the sea in Maine. Hear the seagulls, smell the sea on the summertime, and who knows, the wintertime be freaking, I guess, digging ditches through the snow or something like that down here, because I can't take the cold, but you know what I'm saying. You rent a place up there a couple months a year. 65 years old, my beautiful. I was sitting on the beach reading some books. Going out in the garden, coming down here in this back south, in the 9 months out of the year. I don't need much. Hell, I can live off tuna. Hell, they got Amados up in Maine. I'll eat Amados every day. It's cheap. My wife and I can eat a big fat Amados Italian stuff for freaking $5. We're fine, man. Go for a walk around the beach. You got all the exercise you need. You got the sun shining down on you. How much more do you need? Literally, I don't need a fancy car. I don't need a fancy house. I just need to have access to a garden because I enjoy it immensely, and some kind of outside where I can go walking. I'm not a hiker, but somewhere I could pick blueberries, somewhere I could plant trees, somewhere I could just be outside watering stuff, building hugelkultur garden techniques, building greenhouses and stuff like that. I love that stuff. What else do you need? And that's just me. And then I guess my biggest expense is probably just buying books. I almost said effing. Every single effing book I read, I was going to say friggin', and then almost came out that I haven't dropped an F-bomb in a long time. I don't cuss very often. That almost came out. That would not have been good. And I don't like cussing. But sometimes it will come out every now and again. It's odd. But I was in the infantry, so infantry, you know what I'm saying. But anyway, every book I get, I want to put 4 more back there. And just that's my biggest expense. And I want to get minor league baseball tickets too. So anyway, there you go. Some 401ks let you convert smaller amounts instead of the whole thing. Right on, man. I think it's a great idea. Jeff Rains, man. Jeff, I was thinking about you. Had to work 9 hours today. I had watched this guy, David Hoffman. He did a video on North Carolina mountain music back in the 60s. And it's freaking awesome. It's awesome. I don't think I posted on my YouTube channel, but I thought about my man Jeff from North Carolina. But David Hoffman, let's see if I can't find it. And it's these cloggers who are doing mountain. Yeah, I'm probably not gonna be able to find it. It's incredible. And anyway, if you get a chance, read or watch David Hoffman's videos. It's not just about mountain music. He talks all kinds of stuff. But that was great. I was thinking about you when I was watching this. This fiddlers and stuff. Oh man, Aloha from Maui. Just switched over to Roth while I'm working the yard. Can you review the Roth income restrictions? Yeah. Actually, I got to talk about Roth income restrictions. So I'm looking at it was like 190 or something like that is the max you can do for a Roth. I think it was like 190. Savers gift. Qualified retirement plans. There we go. Yeah, I don't know where this is. It's in here someplace. I don't know why I'm missing it. I think filing jointly, I don't think you can have more than 190 of income for the Roth uh, mark. Yeah, where the hell is that thing? I don't know. It's oh, there it is. It's 193. Okay, so if you're married filing jointly, you can't have more than 202. It's between 193 and 202 for the phase out for a Roth. That's of modified adjusted gross income. So that's before you even take your standard deductions. If you're single, you can't have more than 137. It phases out from 122 to 137. Remember, there's no income restrictions on a Roth conversion, by the way. None whatsoever. Just keep that in the back of your mind. Secondly, I want to talk about Peter had emailed me that last time about the 5-year rule on rolling money over from a Roth 401k to a Roth IRA. And I didn't know the answer. So I researched it, and I was actually kind of bummed to hear about this. If you have a Roth 401k, all right, and you roll it to a Roth IRA, the 5-year rules are on the Roth IRA at that point. So what that means is if you've had the Roth IRA for over 5 years and you roll your Roth 401k to that Roth IRA, you're already done. The 5-year rule is done. You don't have to worry about it. If you just open a brand spanking new Roth IRA in which to roll the Roth 401k over, that has 5 years to it. Does that make sense? So if you're thinking about rolling over a Roth 401k, you definitely want to make sure you put it in, you have a Roth IRA opened already. So that way it can be beyond the 5-year rule. I hope that makes sense. All right. US expat, 1951. All right. Gotcha. Still working, but WEP, when I retire, when is the best time to take Social Security? Well, WEP's only $450 or something, Greg. So not much. I wouldn't let the WEP dissuade you. I would still take it at 70. I mean, just remember the WEP is $450. That's what it is right now. It can change for sure, but right now the WEP is roughly $450. So I think still Social Security at 70 is the way to go. But without knowing your specifics, is hard to say. So sorry, but I just remember, don't let the WEP dissuade you. As the GPO is a big deal. That GPO would be for surviving spouse. Amazon just delivered my 2 books. Hey, right on, man. All right. Well, I hope you get some good interest, good knowledge out of that mushketopotamus. Right on. Bear in mind, I can get full Social Security now, irrespective of what I earn. Right on. Easy path to supplement your 401k as invest in dividend or exchange traded funds. Sounds good on early pension if there's no increase by waiting, but I'll lose health insurance if I take the pension before 65. That doesn't make sense. So you lose health insurance if you take the pension before 65? Oh, okay. Okay, I see what you're saying. So if you wait till 65, you'll still have the pension, the health insurance up to okay, gotcha. Well, that makes sense. No, absolutely. I see what you're saying. Okay, no, I would. That's a big deal, Philip. I'd probably avoid taking the pension until 65. Then you can take the pension, jump on Medicare for sure. Right on a Amero piece of bail with limited liability. I'm thinking of keeping a mortgage so I have a deduction for mortgage interest. Will you? Huh? Think about it. What's the standard deductions this year, Mushketopotamus? I'm not sure you're going to have a deduction. What's up, Nelson? Exactly. As Tom says, Mushketopotamus. So the interest you're paying is over $12,000 a year or $24,000 a year if you're married. Man, spot on. That's exactly right. Interest paid monthly on a 2.4 CD. I see. Okay, right on. Vanguard Wellington Fund is the only fund I have any bonds at 60. Yeah, right on. No, I'm Landon. Vanguard's the Wellington Fund is about 35% bonds. Exactly. Are all ETFs tax efficient and taxable account available with Vanguard only? Yeah, there's Peter. So I hope you got that answer on the question you asked before, Peter. I'd never be so arrogant to say all. I just don't know. The vast majority, certainly, without question. Certainly the Vanguard ones. Yeah, so iShares Vanguard. I imagine the Schwab ones, Fidelity. But I'd never say all ETFs. I'd never say all anything. Can't do that. My man Rob says he's longing to retire in Maine. Exactly. That's my man Dana on here. Freaking he sent me that picture that I put on Fort Gorgeous, Georgia. We used to call it Gorgeous, but it might be Georges. I can't remember. But anyway, that was home. I saw that going back and forth on the boat to Portland every day, going to school. See at Fort Gorgeous. So I posted on my my man Dana. It was on his sailboat. Tough life. But someone's got to do it. Probably eating lobsters in one hand and Amato's Italian subs in the other. With a beautiful lady, his beautiful wife. I don't know if he's married, but here's Josh. I don't do any sailing. I don't care, but let's just use that for example. On my sailboat, got my beautiful wife in one hand, got an Amato sub in the other, and a lobster on the other. I don't have three hands. We'll have to figure my wife. That's what it is. I got my wife like this. She's holding an Amato sub that we're eating together while I got a lobster in this hand. Now tell me that's not a summertime to kill for? Pfft, man. Oh, man. Tell me that's not awesome. All right. So, great question. Dusty or I don't know. ST. What do I think about laddering okay, that's a great question. Instead of laddering CDs for the cashback. Oh, okay. So this is a great question, my friend. Laddering annuities. Be careful. There's something called the serial contract rule. If it's a non-IRA, I'm telling you, man, no one knows what the hell the serial contract rule. I did not know until I went to USAA, and I remember so we had a 2, a 5, and a 10 years CDs, and I fixed annuities, which are flipping awesome back then. This is right in 2009 and 10, and I remember I was saying, look, instead of putting all your money in one of the baskets, why don't we put a third? It was a great idea. And remember, we're doing this all on the phone. So I'm talking about this, and I'll never get this guy, Josh, across the street from me. No, we're in the cubes, not across the street, but across. So you're in these cubes, right? So you're lined up in a cube, and over here's another cube. This guy, was it Josh? It wasn't. Maybe it was my man Ben Johnson who said the saying, if loving the Lord is wrong, I don't want to be right. But anyway, someone from my back had heard me, and they said, you know what the serial contract tax is? I said, what the hell is that? And I didn't even know how to explain it. But the serial contract tax is if you ladder non-qualified annuities, i.e. non-IRA accounts, you can't just take from one without the other two having a say in it relative to surrender charges and tax consequences, stuff like that. It's confusing as all can be. I'm just telling you right now. But if you do it and you do it wrong, guess what? The IRS knows what it is, and they're going to get you. So understand if you're laddering a fixed annuity or any kind of annuity, frankly, and it's in a non-IRA account, what the serial contract rules are. I can't, it's been a long time since I've done that. I can't explain it very well, but just look at serial contract rules on laddering or just fixed annuities. You'll be stunned. No one knows what it is. Nobody does. I guarantee you, if you ask an insurance guy, he won't know what it is. That was the best thing about working at USAA is that they paid me well more than what I deserved, but there's so many guys in there who are true students of the business. I mean, these guys knew their crap. It was nuts how much I learned from these people. I sit there in awe. I will never, ever forget. I had this guy named Heath Jackson, who was my first boss, my second boss. Just a freaking, just a man of men when it comes to financial planning. So again, it's all on the phone. So I remember listening to Heath, and he's just the opposite of me, very soft-spoken, very relaxed, but he'd have these awkward silences, and I'd be like, because what you do is you listen to people. I can't remember. We split headphones, something like that. We call it something. But anyway, you'd listen to the conversation to get a gauge of how to do the business when I first started. And Heath would allow these just what I thought was awkward silences. And the information he got from his clients on these awkward silences was insane. I said, how do you do that? He goes, I just let them talk because I know they're going to ultimately say what's truly on their mind. And it was nuts. I said, man, anyway. And so I was listening to stuff, and I was like, I remember I got to USAA, and I was like, I don't know what this guy's talking about. Like, I had no clue. And I had a CFP. I'd already been 10 years in the business. And I remember I sitting there, I don't have any idea what is going on here. And there's another lady, Heidi Malone. I remember listening to her too. I was like, I'm so far in over my head. I don't think I'm going to pass here. It was nuts. It was crazy. And We got this guy named Chris Borzik. We had David, what's his name? Freaking David Tedesco, who died. I mean, all these guys. It was insane how many people I learned from. And I will never forget that. I was just sitting there thinking, I'm in way over my head. The point about it is that just because some guy has a CFP doesn't mean crap. I'm just telling you right now, because I had a CFP, 10 years business, and I had no clue what the serial contract tax was or contract rules were, among other things. It's just nuts. Anyway, going back to the insurance people, what I found is people who come from an insurance background, even though it's a sales, I get it, know a hell of a lot more about retirement and financial planning than people who come from an investment background. I will lay my claim to that. My observation is that people who come from insurance know much, much more than people who come from investments. So if you have to choose between investment guy or insurance guy, I would go with the insurance guy 100 times out of 100. And you also recognize the insurance guy is trying to sell you something. So he's going to make a good case to convince you to offset your initial bias that you don't want to buy an insurance salesman. But I'm telling you, the insurance guys know more, bar none, than the investment guys. The drawback about the insurance guys is everything is tax-free because they're looking to sell annuities and life insurance, which has their place, but they know a lot more than investment guys. I'm just telling you right now, without question. Hey, thanks, Dan. Dan gave me $2. Appreciate a cup of coffee, brother. I literally much obliged. I really appreciate that. No big scratch. Got to get your right on. Marie, you haven't got my book yet? Jeez Louise, how can I pay for my personal jet to fly around climate change conferences? Oh no, I just said that. We're going to fly to climate change conferences in my personal jet, polluting the atmosphere with CO2. And I'm going to eat a cow, which is polluting the atmosphere with methane gas. But water vapor. No, we're not going to talk about that. All right, anyway. What's up, Harry? Greg in the house. Right on, man. VIVAX. Now, I don't have the fund, though, Landon. I got the ETF, the Vanguard Value ETF. VTV, I think. Joe Stesh, I just went in one day and said, this is it. No big fanfare. Just time to go. You will know when it's time to go. Yeah, I get you, Joyce. Sometimes, if you got the FU money, you can do that. I had to think about it long and hard. But you do know. I was talking to a guy the other day who just wants to leave. He just wants to leave. I said, what's keeping you? And he's worried about it, retiring. And like a lot of men, they'll stay there until they hurt themselves physically. You know what I'm saying? Be it diabetes, getting fat, getting angry, getting the whole thing. That's not good. It's not worth it, man. It's not worth it, especially when you're not adding to your Social Security. Yeah, you're going to save a little bit more in your 401k, but hell, you're probably losing 2 or 3 years anyway because you're hating life. So I've said this a million times Sunday, but man, being free from all that crap is so liberating. I cannot tell you how liberating. Be able to come out here and say this, where I have you all listening to what I have to say, is insane. It's insane to me. It would never happen otherwise, but it would never happen if I stayed at my job. And that might not be what gets you fired up, but this gets me fired up like crazy. And I love it, and I can say what's on my mind. Obviously, some people don't like it. I get that, and that's that's part of the rule. But you can't do that at a corporate environment. You just can't. Mushky Potamus says your tax bond book only gives married couples. I'm a single woman, no children, so not caring about legacy money. Any formulas to convert your info to a single person, no children. That's tough. I deal with a lot of single folks, my friend. What I would do, Mushky, I keep wanting to call you Marie because Marie was just before you. What I would do is I would not convert. All right. And this is going on a limb because I have no clue what's going on other than what you've told me here. What I would do is I would wait until I'm 70 to take Social Security and instead live on your IRAs and 401k money from 62, and I just use that, say you're cutting out at 62 until 70. That's the equivalent of converting. For sure, that's the equivalent of converting. So at that point, I don't know how much you have left once Social Security kicks in, but now you have Social Security and you have 8 years of reduced 401k and IRA balances because you've been living off that money. It's going to be hard in my opinion, to make the case for a single person with no legacy issue to convert. I just, Roth IRAs are wonderful for married people because the surviving spouse is going to live large. They're wonderful for kids, non-spouse beneficiaries, because they're going to live large. For a single person with no legacy issues, I don't see the benefit of it. I mean, I could make a case that the benefit would be that, I don't know, you receive some big, you are the beneficiary of your own non-spousal beneficiary IRA. Your uncle died and left you $1 million, and now in that case your RMDs are through the roof. It'd be nice to have had your money in a Roth by then, but other than that, I just don't see much of a benefit. You got silver gold, right on, man. Simple. Don't forget to smash, says my man Rob. Exactly. Again, another cup of coffee, Rob. I got too much cups of coffee already, apparently. Let's see. Ooh, man. Okay. J.L. Collins, Simple Path book. Is that the same guy, J.L. Collins, who wrote the Good to Great book? Is that the same guy? All right. Jack, what are your thoughts of selling a home, just renting in retirement, upsize no property tax and costs associated with home upkeep? The downside is, that's the problem right there, man, is that you're going to have a rent payment. And it might not quite be a mortgage, but it's going to be an expense that you have to deal with for sure. I'd rather have my house paid for. I guess the way I look at it, you have your house paid for. You can hire some guy for $100 a month to do your lawn. You do got to pay property taxes for sure, and you're gonna have to put the new roof on and whatnot. But yeah, I haven't been convinced on the rent yet. Not at all. I've had, my wife Sharon and I talked about that. Like, what are we gonna do? Maybe we'll rent a place up in Rapid City for a month and rent a place in Corpus Christi for a month and all that. But at the end of the day, we're both homebodies. We both like having the creature comforts of our home. And if we know we're going to be in that one place as our headquarters, I think you should probably just own it. Is there a way in Right Capital to see or specify what accounts of pool or money? Yeah, no, that's a great question. That's a great question, JD. No, that actually ticks me off. So Right Capital does not allow you to pull from your IRAs and 401ks first. It doesn't allow you to do it. It allows you to do it from your taxable accounts. So what happens is it allows you to do a sequential, which is your taxable accounts first, your IRAs, 401ks next, and your Roth last. Or allow you to do it in pro rata, a third, but it doesn't let you to pick specifically which accounts to do it from. The only way to do that, and this will, in my opinion, defeat the purpose, but if you go, you can like exclude other accounts from the planning. So if you have 5 accounts and you say, I only want to pull money from this one account, there's a little checkbox that will say in the net worth. So you go to profile net worth, your investments, you click on specific investments, and then you say exclude from planning. Well, that literally will exclude it from planning, which means it won't pull it from your planning because it literally is not there anymore. So the answer to the question is no, not at all. Yeah, right on. I saw it, Marie. I actually had 216 at one point. I think we started doing some buffering. Some people you can see the people dropping off real quick. So you can always tell you're buffering at that point. All right. Okay. Definitely get some. All right. So Black Belt Shodan, any thoughts on a 4.5% withdrawal on a 50-50? Yeah, I think 50-50 is too much in bonds, man, especially only 54. All right, so I haven't done this video yet, but I did if you look at my blog, if you go to heritagewealthplanning.com, and let me show you what I'm talking about. I'll show you this. Hold on just a second. Nope. All right, so no, that's the wrong one. Hold on just a second. I guess it was the right one. Maybe I haven't posted up yet. Was it the right one? Hold on. Maybe it is. Nah, I didn't do it. I don't know where that article was. But anyway, I wrote a blog post. I must not have posted it yet. I sent it to my email list. Anyway, and the issue was the 4% rule was the reason why everyone's using the 4% rule was because of horrific inflationary times back in 1966 and 1982. It was bad. But even, I can't believe I can't find that freaking post. Damn. But even back during the Great Depression, you could have easily taken 5%. I did a video where I took, let's go back to you, 80% in Wellington and 20% in 10-year Treasury bonds. All right. So we got 80%, 20%. We're taking 5% of the portfolio a year from whichever is up. And this is during the Great Depression. You start in 1930. So we got $80,000 in Wellington, $20,000 in 10-year Treasury bonds. All right. You're taking 5% a year out from whichever one is up and is being adjusted for inflation. Now that survived just fine. But the reason that survived just fine, of course, was because inflation was deflationary. So there was no inflation. All right. So that would give me a little bit pause to say you can do the same thing now. But don't forget, the Great Depression, the markets got hammered. I mean, we're talking in 1930, 1931, 1932, and then fast forward, they got hammered again in 1937. The decade of the Great Depression is almost identical to the aughts of this century. It's eerie how close they were. Now, the drawback is that there was no inflation. It was deflation, which is good for investors to some degree. I mean, I don't want to get into the argument about monetary policy here, but at the end of the day, for someone taking 5% a year out, adjusting for inflation, his spending is going down. And that wasn't what happened in the aughts. In the aughts, we did have inflation. But in the aughts, we also had pretty high treasury bonds relative to what they had in the 1930s. So essentially, that was kind of a wash. So at the end of the day, you were able to survive with Wellington and I guess it would kind of be a 50-50 roughly. Wellington and 10-year Treasury bonds, essentially almost 50-50. Now I think about it, it's almost spot on to what you're talking about. With significant money left over in the Great Depression after those 10 years. I mean, it's nuts. And so I haven't done it for 2000 yet, but I did do it for 2000 with Wellington Fund before. I just can't off the top of my head, I can't remember the numbers, but you survived just fine. So I had no problem with 5%, none whatsoever. The reason the 4% is the mantra is because that was what happened during the inflationary crisis of the 70s, and rightly so. But we're nowhere near that. It's just not here. Now, I grant you, and this is what I said in one of my other blog posts, in 1966, it wasn't inflationary then either. We did not know. You see what I'm saying? So in 1966, it wasn't inflationary. 67, not so much. 68, not so much. Then slowly it started going up. And that could happen again here. So just remember that if we start seeing some significant inflation, you're going to have to pull back. But yeah, I still think 50-50 is too much in bonds. I would do, 75, Wellington funds, 65, 35, something like that. And I'd have no qualm 5% a year. And if you ever get, if the markets fall, 30%, we'll pull back. Nothing wrong with that. Markets are supposed to be good, but Federal Reserve cuts rates. I think they just did that because they felt it wasn't the GDP. They didn't grow nearly like they thought, and they probably raised too much last year, I think. Who isn't a narcissist? Everyone is. Yeah, exactly. What's up with old Clarissa? Oh, boy. All right. Any updates on the course? Yeah, okay. I'm glad you brought that up, Jack. So actually, I jumped the gun on my seminar thing. I forgot about the course. I was so excited to get out of my Splinty, and he's over there on the ground, that I forgot my course. So I'm stopping my seminar. I forgot about it. I got to get my course done. That is my next thing. And Jack, I literally just occurred to me about 3 days ago. I was like, whoa, get that course done. That's what I wanted to do. So two things. I'm working on my book on the Wellington Fund, Retire on Wellington, but I'm also working on my course. So I got those two things going. So I got to, if you're in Georgia and we're thinking about attending my seminar, I'll scratch that. I thank you. And I got, a bunch of people signed up, which is cool. I'll email you, let you know what we're going to do that again. But the course I got to get out. So good call, Jack. Now that I'm up, not quite there to write on the wall yet. I'm thinking by next week, I should be pretty good because I can move it without huge pain, but right there, that kind of hurt. But I think by next week, I'll be ready to rock and roll, and I'm very excited about that for sure. Yeah, right on, Dave C. Sunday nights, man, 8 o'clock. Forget NFL. You got your old buddy Josh. Right on. I think everyone should wait till 70. Appreciate your video on accumulated 8% yearly and coal appreciation. just remember the if everyone waits till 70, the Social Security Administration is going to be in a world of hurt, because that means more people are getting more money, and that would be bad. So if everyone waits till 70, which won't happen, but if everyone did, that's going to put that make the stress on the Social Security Administration so much more. Steven said he's been retired for 12 years from law enforcement. Original pension is $56,000. Our plan is a 2.5% COLA. My current pension is just shy of $70,000. Working 1 more year as a chauffeur. Yeah, you got if you got a $70,000 pension and you're paying into Social Security, you're going to be in a good place, my friend. You're going to be in a good place, that's for sure. So good on you. Yep, infantry. We got a couple of infantry people here. 11 Bravo, yes sir. Is there another Roth IRA? Is there info about Roth IRA affecting single women, no children? I'm sure not in my book. You just have to look around, Mushkey. I haven't done one on that. I haven't seen the benefit of it for sure. So yeah, you just have to. I recently admitted to my coworkers I drive a Honda Pilot, and I kid you not, they all laughed at me. I'm just logical because I don't need a sports car because I make okay money. Yeah, what's wrong with Honda Pilot? I don't get that at all, man. I'm a fan of Honda Pilots. I think they're sharp. I still drive I guess I got kids. That's why. We still got a Honda Odyssey out there. And we got I drive a 2012 Toyota Highlander. Paid for. If you roll over Roth in Q1, do you have to pay quarterly? Quarterly tax are always something of a bugaboo for me. I've seen people who've got tax penalties for doing Roth conversions. I've seen people not. So I don't know how the IRS determines who has what. I don't know. But I'm going to default and say you do need to pay quarterly taxes. Yep, I think so. I did get your email. Right on, Peter. Okay. Have you used personal capital in clients who have invested in single? No. I use Right Capital, Greg. Personal capital, I'd used a couple times. It was fine for retirement planning, but I didn't like it for taxes for sure. What's up, Quincy? What do you think about reopening? Yeah, Vanguard Dividend Growth Fund. No, we don't want dividends in taxable accounts, Quincy. No. We want that in your Roth for sure. Absolutely. So Mushkey says she pays more than $12K a year in mortgage interest payments right now. So essentially you're going to get, let's say $15,000 mortgage interest. Well, you're only going to get $3,000 of deductions. Nothing. I mean, that's still $3,000. I'm not going to poo-poo that, but you're not getting $15,000 of mortgage interest deductions. You only get $3,000 because you already get $12,000 right now as a standard deduction. I think it's now $12,400. So if it's costing you $10,000 a year in interest, and you're only getting $3,000 a year in interest deductions. Remember, that's just a deduction. We'll say you're in a 25% tax bracket for simplicity. That'll be you're going to save how much is that? 3,000 times $750 in taxes, something like that, to pay $10,000 of interest. I don't see the benefit of that at all. Any thought on ETF? Yeah, no, I'm a fan of ETF REITs, absolutely, and Roth IRAs without question. Any thoughts on? So the person says, any thoughts on REITs, real estate investment trusts, ETFs? I'm a fan, and I absolutely agree. I absolutely suggest if you're doing REITs because they're higher dividends, you want those in your Roth. Oops. All right. Wellington Fund was in your email, was dated August 1st. Huh. I don't get it. I didn't get an email about Wellington Fund. All right. All right. So here's Marie, single, no children. Well, maybe that's a good point. Maybe I'll do a video on that. Is a single person with no children and converting to Roth. Obviously, there's two people who have interest in that for sure. Believe it or not, I have a lot of single ladies and men on my channel. Yeah, all right. Let's do it. We'll do a video on that. I need some more details on specifics in terms of numbers. So, Marie, you if you know my email and you want to send me some ideas, I'd like to entertain that. And we won't obviously make it so everyone knows this is Marie, but be good. I'm not sure I want it. Okay. Should a 59-year-old single woman making 125 per year, continuing my yearly 59-year-old single woman, no legacy, making 125 a year, continue my yearly 25K to a Roth. I just got to run the numbers on that. I'm not sure. I think yes, I would continue that to a Roth. I think I would pay a little bit more tax now. 25K is a lot of money that's going to be built up, and it just. I mean, I don't know how much you have in your 401K, but I mean, if you got $300,000 or $400,000 in your 401K, you're only 59 years old. That's going to have some pretty significant RMDs, required distributions, and like Rick says, if you have Social Security, it's going to hurt you there too. Yeah. And here's JD. It sounds just like me. So, okay, there's 3 people who are single with no kids, no legacies. All right. Mushkey Potamus says left coast is too pricey and crazy and filled with homeless encampments that covers streets with garbage, waste, and needles. Scott missed it tonight. Unacceptable. I don't agree with that. Infantry, right on. Yeah, another infantry guy. We got 4. All right, so we got a bunch of single ladies, it sounds like, and a bunch of infantrymen. That's nuts. All right. So Mushkey Potamus says NFL National Felons League. Yeah, I don't know. I get there are a couple clowns, but they're clowns in every aspect for sure. Steelers have Pats on Sunday. I won't be calling a sit, brother. Just look, I like the Pats. I love the Pats. I was the biggest freaking fan ever growing up. I get bored watching sports nowadays. The only thing I like watching, actually, and it makes me nervous watching, is because I get too nervous watching the Patriots. There's no other way around that. I get too nervous, especially playing the hated Steelers. I can't. It makes me too nervous, so I stop watching it. And then when I stop watching it, I said, I get all this other time to go out and do stuff. I'm being more productive. It's like giving up Facebook. I said, the sun's actually shining. Let me get outside and enjoy the garden as opposed to getting frustrated because Bill Belichick always freaking passes on first, incomplete. Then he'll run on second. So now we got 3rd and 8 every single time. Like freaking Belichick. I thought you're supposed to be this genius. Or what is it, Josh McDaniels? Why? They do this every single time. Pass on first, incomplete. Run on second, 2 yards. 3rd and 8. You're not going to convert many of those, only because we have Julian Edelman, who never gets always breaks a tackle and gets first down yardage. If we did not have Julian Edelman, we would not have, and I say we because I was playing on the team, we would not be where we are. If he can't break those tackles and get first down yardage on 3rd and long, Belichick doesn't look like the guy he is. Tom Brady doesn't look like the guy he is. It's because Julian Edelman can break tackles. If we didn't have that, and they don't teach tackle anymore in the NFL. That's all there is to it. Jeez Louise. Here's another one. Single no change. Okay. Well, I'm definitely doing a video on that, man. I don't want dividend ETFs in your taxable account. Well, if you don't have, low balance, no big deal. If you don't have much money, it's not going to hit you. You only live once. Ditto. Fire. Right on. All right, got a lot of single people here, man. When can I resume exercise? I've been doing a lot of walks, Jack. I can't put more than 2 pounds up. And this is what the guy said. He didn't say anything about not getting under squats, so I'll probably start doing that again next week. I do miss squats. I got these little things right here for strengthen your forearms and whatnot, I guess. And then this thing right here is pretty cool. Ooh, that hurts though. That's good. I don't know why the physical therapist makes me do it, but you can feel it. That hurts. Can't do any pull-ups. Can't do any obviously overhead presses. I'll probably get on squats this week though. I'm looking probably an empty bar initially, maybe 25 pounds on both, just to see, because that doesn't hurt, but I haven't gone down yet. I am a little bit worried about it right in there, but I haven't. Whoa, Rob, take your flipping money back. Rob said, "Go Steelers." Oh, how I hate the Steelers, man. Franco Harris, immaculate reception. Remember that? All right. All right, so we're gonna have to do some studies on Roth conversions for single people. Absolutely. I did, Scott. I'll set you up tonight, or not tonight. I'll set you up tomorrow. You want to get mad? Watch the Vikings, man. But do you remember that freaking catch in the AFC? No, it was the NFC Championship. That game against the freaking, was it not the Saints? I guess it was the Saints, right? 2 years ago. That was insane. Hate the Saints, man. I know I got probably a lot of Louisiana people on here, but man, hate the Saints. Always hated the Saints. Any team that plays in a dome, Vikings. Saints. The old Seahawks used to play in a dome. The freaking Atlanta Falcons playing a dome. Why do the Falcons need to play in a dome? You're in Atlanta, for heaven's sake. Yeah, all right. So lots of single people. All right, so that's good. All right, we got a lot to work on this week about single people and converting. Okay, we'll make it happen for sure. Jeez. Yeah, don't worry about it, Mushki. She says she doesn't know how to answer people back or chat back. It really is not very good for that. This right here is tough to do that, Mushki, because you say something, you're not sure when it's going to go. Yeah, I'm running out of steam too there, Rob. So I'm going to get ready to call it. But all right, lots of disability here. Lots of disability. Lots of single people here. And Marie Landis also needs to never come back to the YouTube channel being a Steelers fan. Oh, yeah. Steelers. Man, can't stand those guys. Always hated the Steelers. Always. Just because I was a huge Raiders fan growing up. Hey, Rob Klein, what's up, man? Raiders, because my granddad had season tickets to the Raiders. Ken Stabler, Dave Casper. And I just loved him. Had a Oakland Raiders trash can, still do. I know. I got you, Mushki. You're saying you're not interested in a Roth conversion. Other people are, though, so we'll put that in there. We'll run a couple scenarios. Yeah, exactly. It's easy to miss someone's comments until we follow the chat at the point. Josh is reading the comments. It is easy to miss someone's comments. And Marie, it's hard to write back to. It's easy to write back. It's hard to write back to somebody specifically. That's the thing. So I'm not sure how. I guess you do it. I'm not sure how you do it. Rud see a 401k Roth. All right, yeah, all right. We'll run that for sure and see what it looks like. So we'll run a couple of different scenarios. Absolutely. We'll say someone's making $125,000. She's 59 years old. She's single. All right. She had no kids, no legacy, and we'll make up. How much should we say is in the 401k deferred accounts? So you guys want to give me some ideas here? So we have a 59-year-old lady, and it doesn't matter if she's a lady or not. She has 125,000K income, no legacy requirements. Craig says 1.2 million. 250. Yeah, it's kind of going along those lines too, Marie. 250. And then we're going to put 25K into a 401k or Roth. All right, so we got 250, 1.2. Mushki? Mark, do you know what you're talking about, man? Have you no clue? Do you not remember? Do you not remember the years 2 and 14? 550. Okay, there you go. 550. All right, that sounds pretty good. All right, good. Do you not remember the Steve Grogan? And never mind freaking Tony Eason from the University of Illinois. Stanley Morgan missing that pass in the 86 Super Bowl. The Pats. But the Patriot guy, Hiking, is the best. All right, so you got 129 in a rollover. Okay. So we're going to go with, we'll probably go around 250, just get a gauge. You got 129 in your rollover, but you didn't say how much you have in your 401k. Oh, wait, is that? Yeah, so we'll run around some numbers here and see what it looks like. It'll be fun. When is your interview with Wade? My interview with Wade Pfau is Friday. We'll talk reverse mortgages with Wade and anything else he wants to talk about in terms of retirement income planning and whatnot. Wade's a good guy, and definitely looking forward to talking to him for sure. So don't forget, I've got a bunch of questions so far. So you have more questions about me, about reverse mortgages you'd like for me to ask Wade, let me know. All right, my friends, I'm going to call it a night. I got some boys are having a sleepover, so we got 3 kids that need to get their butts in bed. They should be already, and I'll work on some of the stuff for these single people on Roth conversions and Mushkey. It's okay, Mushkey. We're going to talk Roth conversions, and we'll step back and do additions to Roth 401ks as opposed to traditional 401ks. That makes sense? You got it, Jack. In scenarios for pension, no Social Security. We'll see what we come up with. That's good. So we'll see what we got. Sunday at 8 p.m. We'll see you next week. Thanks, guys.